Good evening, everyone joining us. Happy budget evening. Hopefully there's some relief around people who are joining us. I'll give it just a little while just to welcome everyone in. Good to see you all tuning in from all over the UK. So yeah, just give you a couple of minutes just to get everyone in. Oh, it's great. Great to see so many of you joining us. I wonder how different it would have been had today's announcement been slightly more negative. Right, I think that's everyone seems to be joining, so I think we'll get going. So this evening's webinar, as I'm sure most of you are aware, mastering the market post budget. So after today's slightly more positive announcement than I think the markets maybe anticipated, Mark and I are going to be talking through the announcements from today. But crucially, this webinar is about how to make smart decisions. So obviously a lot of reaction, a lot of movement in the market in the lead up to the budget, and obviously in response to the budget today. But we want to really, having gone through some of the highlights, we really want to talk about how to use the StockRanks and our screens and sensible decision making to make good decisions and hopefully improve your results. So just a quick disclaimer. Obviously, the value of shares can go down as well as up. Remember to do your own research, and none of what we say this evening should be considered advice. I'm Megan Boxall. I'm the head of content here at Stockopedia, and this evening I'm really pleased to be joined for the first time on one of our Stockopedia webinars by Mark Simpson. Mark, I'll let you introduce yourself.
Yeah, thanks, Megan. So yeah, Mark Simpson, Stockopedia freelance writer, and also a value investor, kind of really tend to focus on those more unloved situations, and when value gets dislocated from price, and I think we've seen quite a bit of that recently, so hopefully some interesting times.
Yeah, great. So just a quick agenda for today. As I say, we'll go through the budget announcement first, those sort of highs and lows from the announcement today. Is splitting it into two different sections. The first one, sort of tax changes, which and general updates that have impacted certain businesses, and also personal finance updates. We're then going to switch gears slightly and really look at that value. As Mark said, he's a specialist in the value sections of the market, and at the moment there are certainly value opportunities in the UK. So we've got three sort of strategies to talk you through, and then going on to some ideas and opportunities. Mark's put together some screens, and we can talk about some of the opportunities that look like they might be coming out of those screens. Just quickly, a little bit of admin. I'm sure most of you have seen the chat column, so get your questions in there. We'll try and answer as many of them as possible. We've got Lawrence and Keelan from Stockopedia in the control room this evening, so they can help you with any admin-y side of things, and also any questions that you have. So yes, let's get going with the budget overview. So quite a wordy slide this. The slides will be available afterwards, but Mark, do you want to briefly touch on what your highlights were from what leapt out at you from Rachel Reeves' announcement today?
Yeah, well, it was sort of all eyes down for a couple of sort of major changes for investors. So the first one was capital gains tax rates. So here looks like they were brought in line with the rates that property investors have. So that's the lower rates going from 10 to 18%. So that's quite a big jump, but also probably doesn't affect that many people. And then probably more well used, but sort of not a major change, is that higher rate going from 20% to 24%. I think many people potentially expected worse. So some of the press stuff was saying that might go from 33 to 39%, which would have really had a big that sort of rate would have really had a big impact on investors. And it does happen overnight or immediately. So it's already happened, this change. So those who sold in anticipation of this, and I think this is what I remember, is the change, the impact of this budget doesn't just happen now. It's happened over the last couple of months as people have been anticipating these changes. So that one, I think investors potentially got right. People who are taking long-term gains to avoid this increase. And there's a couple of things that I guess were risks. So first was a change to ISA allowances. The next one was changes to the tax-free lump sum for self-invested personal pensions, and no changes were announced here. So that's quite in that sense, that's kind of positive. But I think the effect of the fear of that has also has had an impact on the market over the last few months. And finally, the big one for investors is lots of people feared that AIM business property relief from AIM shares was going to be removed completely, which would have been quite if that had happened, I don't think we would have quite the same smiles on our face today. That would have quite a big impact on the industry, kind of the careers of fund managers, and also on individual investors' portfolios. As it stands, they put in effectively a threshold of £1 million of estate is tax free, and then IHT on AIM shares gets a sort of 20% rate of tax above that. So not completely tax free, but I think the majority of these sort of portfolios are smaller, kind of small portfolios of shares that people have, and comes to the balance, it feels a sort of fair compromise to me. And also perhaps like gives a bit of certainty, so future chancellors can play around with the tax-free lump sum potentially, or the threshold, but the principle kind of stays, and I think that's an important thing.
Absolutely, yeah. I mean, I've grown up in a household where AIM is very much a beloved market, and I feel like this seems quite fair. It seems quite a sensible update. I think this is something that is quite a significant thing for a lot of our users. So we'll dig into it in a little bit more detail. Just quickly on the sort of headlines. Obviously, we can see the response of AIM today really shows that this is a budget that was well received by AIM investors. I mean, some of the shares, especially some IHT qualifying shares, really did have quite a pleasant day today. FTSE, I mean, pretty much flat. Nothing particularly concerning, I guess. I guess a bit of an interesting comparison with the Liz Truss budget, which obviously caused a real dive in the FTSE. This is a relatively muted response in comparison, despite the fact that this is a budget full of spending, full of increased borrowing. Although obviously plans to get the borrowing on track, but we are seeing increase in bond yields. But FTSE, not too badly affected by that today. So just drilling into, this is also shows that sort of the run up. AIM investors were definitely expecting the worst, I think, from this budget. But just drilling into that AIM point a little bit more, because I think just really clarify, we've got a few specific questions about what that AIM IHT relief means. So as Mark said, before AIM shares qualified for 100% tax relief, the announcement that's come through today is, it was sort of a little bit confusing when it was announced, because there's the £1 million threshold at which business relief and agricultural relief will kick in. So you have 1 million completely inheritance tax free, and then the 50% reduction on for business rate and agricultural relief. That doesn't apply. That £1 million threshold doesn't apply to AIM shares. So an entire AIM portfolio will be taxed at the 50% relief. So, and it's an effective 20% tax on AIM shares. As far as my understanding goes,
that's interesting, because I missed that point, and it's one of these things of, it's actually quite tricky to often work out
exactly
what the meaning is. And those who are uncertain, there is a big budget document that you can kind of read through the details. And also, I noticed that quite a few of the kind of gov.uk, have ideas. Have details as well. So I think, obviously we are not tax experts. So if you're affected by this, do get that document and do check it out, or do get somebody who is a qualified tax advisor to talk that through with you.
Absolutely, yeah, because as you say, it was some of the announcements were quite difficult to follow exactly what was being said. One that was less difficult to follow, quite a clear update, is this second update about IHT, which is the fact that inheritance tax is now going to be paid on inherited pensions. That's quite a significant change. Quite a lot of potential tax money to be raised via that. But again, it does seem like quite a sensible way of raising a bit more money. This has potentially an upside for AIM. There is, a lot of wealth managers have in the past been looking at pensions as a way of sheltering their clients from inheritance tax. And actually, with the removal of that, there is potentially a little bit more attractiveness around AIM and that junior market. So and that might be another thing that's been providing a little bit of stimulus to the shares today. You can see here in this chart, these are the top movers on AIM today. 68% was one of the shares, which is obviously quite a massive one-day move. I mean, but also even companies like Craneware. Craneware is a relatively well-established, quite a large AIM-listed company. But yeah, 23% move today. Quite interesting. Mark, I know you had some thoughts about some of the biggest movers on AIM today.
Yeah, well, it's been far from widespread. It's not like every AIM stock has gone up, by a significant amount. And I think part of it's a bit of relief. People are putting money into things that have fallen, and we're going to look a bit later at some screens that kind of pick out the potential opportunities there. But I personally, I look through, and I think there's some of the more popular stocks, with private investors that are getting bought, which is on one level good. You're seeing a recovery in things that are sold off. But my sort of contrarian sort of spidey sense starts to tingle a little bit, because it feels like when the rally is quite narrow, it means that people are putting money into kind of stocks they've heard of, or other people have talked about, and they maybe are not picking absolutely the best stocks for them. They're not kind of going for things that they're personally comfortable with, that they've researched in detail, you get a lot of kind of crowd following in markets, and we've seen that even in the weak markets we've had over the past few months. Something like Card Factory, for example, had a small overhang clear. I think we're going to look at the chart in a little bit later as well, and suddenly it went up 40 or 50% as people decided that, well, somebody else must know something good, and then they bought the stock, and then somebody else thought, oh well, if everybody else is buying this, then this must be good, and the kind of share price went up, and then when the trading from the company was announced, then it quickly gave back quite a lot of those gains. So it's it's a day to celebrate. If you have any of if you held Craneware at the start, or you particularly bought into it in the last few days, this is a great day for you. I just think that people need to be careful about just say looking at this list of the best advancers and thinking, oh well, they must be the best companies to invest in. That they might just be ones that happen to have caught the investor's imagination today, and we don't know what will happen tomorrow.
Yeah, absolutely. And I mean, it's not just on AIM that's true. We've obviously seen today, as Mark said, the change in the capital gains tax, which potentially it was well done to anyone who sort of sold their shares to get in with the lower level of capital gains tax, because as Mark said, that has come into effect today. There are some other positives where there's been no change. So our ISA allowance unchanged, and also the tax-free lump sum on pensions unchanged. So again, potentially positive things that have had a slight impact. So these are the FTSE index advances, not quite as severe as with AIM, but obviously same sort of situation where some of these big movers are the popular stocks, the ones that grab private investors' attention. So as Mark said, worth being wary as to why those shares have moved, and whether just piling in because the share price is doing well is the right thing to do, especially if we see especially as we see sort of the months go by, and if there is, when we start seeing results from these companies, do they stack up to the kind of movements they've had today? So yeah, we at Stockopedia like to stick to the rules rather than the stories, and we'll go on to some of these rules in a minute. But yeah, just something to be wary of.
Interesting to see sort of an asset manager in there, and obviously that what people are anticipating is that a lot of this cash that's now sitting on the sidelines. And I think that is a real positive for these markets, is if you're somebody who took your 25% lump sum out of your SIP, you're probably not going to have all of that in cash or just buy a sports car with it. You're probably going to drip feed that back into ISAs and other investments, and that cash is potentially kind of coming back into the market. And I think that's what's been priced in by kind of Lion Trust here, but not all the asset managers have risen as much as Lion Trust, and they might be a bit weaker over the next few days as well. So I think there's still potentially an opportunity in that sector. I think Roland has written or is potentially writing an article on that topic, isn't he? That will help people guide through what's happening in that sector.
Mm-hmm. So I'm actually just going to skip back to a slide that I skipped over before, just to talk about this slide, because I think that relates to what you just said, Mark, about retail fund flows were negative in July and in August. Obviously, people taking the money out of the market, but as you say, potentially means there is a lot of cash floating around at the moment, which could then see the retail fund flows move back into positive territory, where they have been for most of the year, most of 2024. So some negativity in the summer, but yeah, potentially that means that there is money to be invested. So then moving on to the more specific business headlines from today's budget. I think we've had a question. Wasn't the budget negative for employers? Yes, an increase to employer national insurance, so 1.2 percentage points to 15% by April 2025. Yes, that does obviously increase the cost of employing people. And the other thing that is going to increase costs for businesses for their staff is the increase to the national living wage and the minimum wage. Two companies we've flagged in this share price chart here are Card Factory and Shoe Zone. So obviously they've both had quite bad years, but both had quite positive share price movements today, probably because they are popular stocks. But I think the headlines from what's been announced today is negative for companies like this.
Yeah, I think that you've already seen both of these companies Shoe Zone have had a couple of profit warnings, or let's say downgrades in expectations, and Card Factory, although has said they will trade in line, the share price graph there says nobody believes them. And it is all around these costs. The costs that they're, both companies are seem to be trading okay in terms of revenue, but their costs are going up more rapidly than their income. And these sort of raises in the national living wage and the national minimum wage are going to potentially affect these companies more. I think it's worth thinking through that, that they might be companies where it's harder to automate there, because one of the risks of both of these changes is that it pushes companies more into automation, and companies that provide automation may actually be winners from this sort of change. But anybody who's tried to put a card through a Sainsbury's or Tesco's self-service till probably knows the number of bagging alerts that these things generate, or just don't register. And I think that it's certainly possible, but they might be some of the harder places to automate versus, McDonald's, where you have an app to order your food, for example.
Yeah, but then there's also other areas of the hospitality market as well that I think automation is maybe going to be harder. I think pubs benefit from having people behind the bar, and I think that pubs got a. We were saying earlier, one of the biggest cheers today was the 1p decline in the cost of pints because of draft beer duty being removed. So tiny little saving, but clearly very, very popular to members of parliament. But it's going to be completely outweighed by this increase to national insurance contribution and to the minimum wage and the national living wage. A lot of students work in bars and in pubs and things like that, and automating there. The cost of implementing automation into companies like that is obviously pretty extensive. So regardless, these companies are going to see costs increase. But again, these weren't particularly badly affected stocks today. General positivity in the market seemed to keep some of these stocks in positive territory today, but maybe something to be aware of and be wary of, especially next time they announce results, because we are likely to see the costs increase for companies in this sort of retail, hospitality, leisure space.
Yeah, one of the commenters I see has just popped up and said that reminders that Paul Scott did a bit of analysis on this and said that you could see as much as a sort of 30% reduction in the profit of some of these companies from this change. So the likes of Wetherspoons potentially being up on this budget news is looks to be a bit of a disconnect. If you hold shares in that sector, probably worth doing a little bit more research into these specific changes.
Mm-hmm. The other slightly, well, I mean, certainly a hard one to explain, but we think we've roughly got to the bottom of it, was the fact that fuel duty remains frozen. So this is something that is positive for consumers, obviously, probably a sort of move to keep inflation at the lower falling rate that it's been at. But the second one is that the government did announce an increase to the windfall tax on oil and gas companies. So oil and gas companies tax sort of the basic level of taxes at 40%. And then the windfall tax is now have been raised 3 percentage points to 38%. So the effective tax rate on these companies is 78%. So very high level of tax for companies in the oil and gas sector. But within that base 40%, there are some capital allowances which allow companies to offset the cost of some of their investments. These have been maintained within the sort of 40% part of the tax, which goes some way to explaining why Serica was up 13% today. So Serica, obviously very well-held stock among a lot of private investors, hasn't had a good year, and its chief executive actually made a lot of noise over the summer about what these capital allowances, removal of these capital allowances, might do to investment. So the fact that these haven't been completely removed is a positive for companies like Serica.
Yeah, you see the sort of, was it 13% today, reflects that change, but I think also reflects how far this had fallen, and how big the fear was that all of those capital allowances were going to be removed, and they also get something like 100% capital allowances on the 100% relief on the first year of capital allowances. So it's a complete removal would have been quite severe. And what this does for Serica, I think the management in their last presentation, when the share price was about £1.20, said, "Oh, we're going to, worst case, we earn our, in cash, our current market cap over the next 4 to 5 years." So I think part of the recovery is reflecting the market's fear that this could have been worse. This isn't per se positive for the oil industry. It's just better than a lot of people were expecting. And I think Jersey Oil and Gas was a really big riser today. At some point was up over sort of 60% and maybe closed up over 30%. So any company that has a lot of like a quick payback on their investment, so the typical kind of infill drilling of that Serica's doing, any of those things stand to benefit, or certainly benefit more than the worst case scenario that was being trailed before this budget. So it's a bit complex, but it is good news. It's good news in the bad news, which probably is a good summary of the budget in total.
Yeah, absolutely. Just to address one question, when do these changes come into effect? All sorts of different times. So as Mark said, the capital gains tax changes already in effect. That's happening as of today. IHT changes to AIM, they don't come into effect until April 26. So really impacting the tax year to April 27th. So that one, you've still got a little bit of time. So and sort of everything in between there. So I think if you've got any specific questions, as Mark said, that the information is all available via the government's websites. But yeah, I don't think we've got time to go through the specific dates of every single change, because they are as of today.
This oil and gas one is from tomorrow, so this is an immediate effect, I believe.
Okay. Cool.
It's worth just on that point,
yeah,
thinking about there is that it's not necessarily a cliff edge, but the market might start to price changes then coming into the April. So obviously the capital gains tax stuff and the any of that stuff is gone, but the inheritance tax on AIM shares, you might see investors anticipating that or making changes to their portfolio in the run up to the end of that tax year, and therefore we might see some interesting opportunities. Even if you kind of feel like, oh, I've missed the boat on some of these bargains now, we might see some of that come into play in the future.
Which is a great segue into section 2 of our webinar this evening. These slides, I must admit, I put together before the budget today, because I was anticipating having to do a real defense of AIM in this webinar. I stand by it. Obviously, AIM is not a market to track, but there have been some great returns. These are 4 companies that are actually coming out of a screen I've put together right now. These are sort of high quality AIM companies. Gamma Communications up 500% in the last 10 years. So a pretty spectacular performer. Bioventix, which actually is one that is currently emerging from a potential value opportunity screen, which is interesting because obviously it's up almost 400% over the last 10 years, but it did sell off quite a lot this week after its results. So we'll come on to talk about some of those opportunities. We won't dwell on these slides because I know we want to move on to some of the opportunities, and AIM's fine as of the announcement today, so don't need to go into it in too much detail. So how to identify opportunities in a sell-off, as Mark said, potentially if there is a cliff and when the IHT changes come into effect, or just generally if once people settle down after the announcement today, that realise that maybe it's not all positive. Maybe some of those retail hospitality sectors start selling off a bit more. Regardless, we at Stockopedia want to make sure that people know how to use rules and real discipline. So Mark, as a value investor, is a great voice to have on the webinar this evening. The first sort of type of value we're going to talk about is one that, Mark, I know you know very well, deep value stocks. So opportunities that arise from overselling. This is something that I pulled out of an article that you wrote. I think this was a company that you invested in personally and bought at a good time. Do you want to talk through the sort of overall strategy behind deep value investing and how to identify opportunities like this one?
Yeah, so typically deep value investing focusing on the assets of the business, and accepts that some businesses go through periods where those assets are very unproductive. The business can often be loss making, it can kind of really struggle, but the forces of capitalism come into play, and actually managers change. So shareholders kick out management and put in different management. Shareholders or management close plants that are not making money and only keep the profitable parts of their businesses, or they invest in a new product and that one takes off where others are declining. So it reflects that if you buy really cheap companies, the law, the kind of mean reversion, that power of capitalism actually works in your favor. And as the risk of investing in very high value, high growth companies is that same power of capitalism works against you. You see competitors coming in. If you make great margins on a new product, but it's not patented, your competitors come in and make the same product a bit cheaper. And the sort of theory here is that if you wait for those kind of extreme points to sell off, you buy the assets of business for far less than they're worth, and wait, you can take part in that recovery, and you can generate very good returns. This is a company called ZAR that actually I bought when it was sort of sub I think it was sub 20p or something like that. I'm not sure quite what the scale.
I think in your article you did say it was about 20p, and
yeah, not quite sure what the scale is on this one, but the yeah, it was during that COVID period, and the reason I bought it was trading below the value of its inventories, the cash on its balance sheet, and that was pretty much it. So, you know, maybe some receivables there, and trading at quite a big discount. And not every company gets this cheap, and to be fair, I sold far too soon. I think I, you know, started selling when it got to about 50p, and it probably went up to about £2 at some point. So it very much is it's a difficult strategy, because when I bought in, you know, kind of March, April 2020, it looked like the world was going to pieces. You know, we had COVID running rampant. Nobody knew what the earnings were going to be. You know, were pubs going to be open in 6 months' time? Nobody knew. You know, were businesses going to be bailed out at the time? Nobody knew. So the fear and the uncertainty was really, really high. And, you know, that, you know, the time, you know, that sort of buying when there's blood on the streets, as the phrase goes, often pays off. But it's very, very hard because of the level of uncertainty you have. What I like about you know, the kind of current sell-off of stocks we've seen is we might not have seen quite the same level of sell-off. You know, this was a stock that, you know, absolutely plummeted, and then mainly recovered. But it was, you know, we know now that there's probably not that much wrong with the businesses. You know, yes, consumer sentiment's been a little bit weak. We've seen, yeah, you know, like the economy hasn't been great in the UK. There's genuine issues. There's small tax rises for employers. There's, you know, there's a few things there, but it doesn't have a level of uncertainty. This has very much been a sell-off driven by people selling for tax reasons, rather than that they're uncertain about the business, or they believe the business is not a good business anymore. So I quite like these times, because it sort of requires a bit less, to buy requires less sort of faith in the future of these businesses. You know, these businesses, you know, if you've done research, are reasonable business. You know, it's in some way an easier way to invest, but the principle's the same. You buy the cheapest businesses that, in all the uncertainty, the asset value gives you that anchor that says, well, this business is probably worth more than the current share price.
So yeah, and I think that is, especially with deep value, quite an interesting point. And this is a slide, as I say, the slides will be available afterwards, but just to show sort of the calculation around net current asset value. And it is, so for the deep value strategy, this is one of the ways to identify potential deep value companies which have a net current asset value which is less than their current market capitalization. There are a couple of different ways to calculate net current asset value. This is sort of a basic sort of look at the current assets and take away the total liabilities, and then you're left with the net current asset value. But Mark, I know that you favour a slightly more of a more conservative calculation to net current asset value.
Yeah, you essentially kind of look at those assets and you say, well, what would they be? What would you receive in a fire sale? And you know, sort of cash is assuming there's no fraud in the business. You know, kind of cash is cash. Receivables, you tend to get customers being a bit picky about paying if you're closing down the business. So you often kind of discount that to maybe sort of 3/4 of that value. And inventory, it really depends what it is. You know, if you know a business that has a lot of you know, like oil, for example, you know, kind of oil you can sell on. You know, if it's raw materials at cost, you know, and the cost of them, you know, the commodity price hasn't changed much, you know, you can sell it on. Whereas a massive sort of set of you know, bespoke produced products in lots of variants, probably isn't worth much to somebody unless they really want that product. So on average, you probably take about 50%. You take about half the value, but you do need to go into the details a bit. And then some, this is like really, really cheap here. That some people might also take kind of property into consideration. So that's not quite as deep value as this this bargain issue as Ben Graham called it, but it's having an understanding of, well, what actually are you buying on that balance sheet, and applying sort of sensible deductions to your own, based on your own judgment.
Mm-hmm. So yeah, Ben Graham, a classic quote. So you can view that if you look back through the slides. But just to comment on, Daniel Jones has just pointed out that you can screen for so the more conservative approach to net current asset value that Mark just described is what Ben Graham called net. So you can screen for that in Stockopedia. There are currently nine results in the UK. If you are looking at a net working capital of less than 2. So Mark, this is again something that I took from you. So this is not looking at a net asset value less than the market capitalization. It's giving a little bit of room for maneuver because obviously giving it as less than 1 is I actually don't think there were any any companies that came out of the screen like that.
It's worth what I find is it's worth having an idea of what's out there, and then on a bad day, you know what's already on your watch list, and you know what's worth considering, but you have to be careful with this strategy, because, for example, take a Nexo there, which is the one that gets closest to 1. Personally, I would discount their receivables quite highly because of the nature of the business they're in. They're sort of credit hire vehicle providers, and they're sort of providing a service to customers that don't really want to pay, which means they take a long time to pay, they argue over things, so you might find that in that case there's quite a lot of receivables that give it this quite a good value, but you also want to apply quite conservative adjustments to what people are actually willing to pay in that situation. I've got an example of another net if you'd like me to go through it now. Is that worth talking about? So there's a company called Zytronic, which I have invested in the past, and if you look at the values, probably comes out as a net on, or certainly one if you include the value of its freehold property, and it's an interesting situation because it's going through a strategic review to potentially kind of close its business down and return that capital, and this is a situation that might indeed pay out more than its current market cap in cash during that process, but it's not what I'm currently invested in because I think there's quite a lot of uncertainty over some of those asset values. For example, the factory, that the freehold property is a factory not in great condition from some reports, in a place where property is not particularly valuable, and that its inventory is quite bespoke, and its customers, it still has contracts, it's still producing for customers, so there's potentially costs involved of saying, well, we're going to stop manufacturing for you, our customer, who we've agreed a long-term agreement with. So all in all, I might just be scared out of this. This might be actually a very good opportunity, but for me at the moment, there's too much uncertainty about what those assets are worth for me to to say this is a good investment at the moment. In fact, with all these style of companies, you're much better if a company doesn't close itself down, because there's insurance costs, there's a lot of costs in there that you potentially haven't budgeted for. What you really want is this is a sign that somebody's going to come in and turn this round.
I suppose, you're not looking for ones that completely collapse, the ones that get right to the edge and then retreat. There has been a question, I think we'll just touch on this briefly because we've already done 45 minutes. We've got a few more things to talk about, but question on strategies for selling. And I think that is particularly interesting with a deep value strategy. As you say, Mark, you potentially feel like you sold out of ZAR too early, but is too early better than too late with a strategy like this?
Probably, because it's really hard to sell on the way down. People get anchored on that higher price, and I know I do the same thing here of once something peaks, so all the theory says, well, you should sell after that peak on this graph, but it's really hard to do because you become anchored on that high peak, and then you think, oh, I'll sell when it gets back up there, and of course when the momentum's fading, it never gets there.
Yeah, we've actually done some research on this, which we'll touch on in a bit. I'll touch on it when we talk about the contrarian strategy, because I think we applied this to more contrarian stuff. So obviously, deep value. Not saying that these companies are necessarily basket cases, but some of them maybe are, but they're just currently trading under that net asset value. Contrarian, slightly different strategy, because it leans slightly more on the fact that these are high quality businesses, and which maybe have just been involved in a short term sell-off, potentially something negative out of their control which happened to them. Warren Buffett, a classic example. This is when Warren Buffett bought JP Morgan. It was around the time that Lehman Brothers went bust. Obviously, lots of bad things happening to the banking sector in the US in 2008. But there were high quality companies which remained in that sector, and obviously Buffett benefited massively from his stake in JP Morgan and in other banks. So Joel Greenblatt, a classic contrarian investor, find out the value of something and then pay a lot less for it. And it's a strategy that has done very, very well. I think actually, Mark, this was another one of your screens that we back tested, a Buffett contrarian screen, and we've got some results from that as well. So this screen looks at the highest quality ranked companies in the market, so the top 30%. Also those with the highest gross margin, but with a high earnings yield, an earnings yield of above 5%. I actually decreased that. I think you had it at 7%, but I brought it down a little bit because there weren't that many results from the screen. Slightly too few results. This I actually did do not today, so I don't know if the exact numbers have changed, but 11 results on AIM at the moment for a screen like this, and 17 on the FTSE. A large number of the ones on the FTSE are financial companies, interestingly. But identifying oversold shares, I think, is a strategy that I really like to look at. So how do you feel the deep value compares to the contrarian approach to investing?
Yeah, I think that they sort of end up being complementary. If you end up with only a portfolio full of deep value investments, you end up with like either very few stocks, or you really have to water down your quality rankings. So I think adding in that quality aspect, but also being kind of strict on valuation. I think that I've liked gross margin, but I did some research for Stockopedia on did the high ranked the super stocks, did buying the high gross margin ones outperform, and it actually didn't. Now that might become because it ended up stuffed full of all of these financial stocks, and then you're very much dependent on the performance of the financial stocks rather than what the gross margin is telling you. But I did think it was interesting that potentially, I probably favour a different measure of quality, and I've got a screen that roughly does the same as this in a bit.
Yeah, I mean, I actually also prefer operating margin, and I think my favourite is return on capital employed. So we'll come on to those opportunities in a minute, because I just want to touch on the results from the study that we recently did. So as you said, Mark, buy when there's blood on the streets, but when should you sell in this sort of situation? And this is this study that we did was based on a sort of theory that you put together on surfing the StockRanks. So trying to buy when the value of a stock is good value, so the value rank is high, and surf the wave of high value rising momentum, but then jump off before that momentum crashes. So the sort of rules we set around this were buying when the Stockopedia value rank was more than 90, and selling once the momentum rank had fallen for 3 consecutive months. And the results were brilliant. We were very pleased with this. So over 100% returns over the 10-year period that we tested this on. And
I assume that's price only in a time that the FTSE did 25%. So
exactly, yeah.
It doesn't sound amazing for 10 years, but that's that compared to the market, that's really good.
Yeah, and I guess for me as well, it's that sort of clarity around the selling rules, which I think is something that we talked about in the webinar that Ed and I did a couple of weeks ago. But it's really that discipline around selling, and I think this is something that I definitely struggle with, especially with those sort of contrarian plays. It's very tempting to think of them as stocks to buy and hold forever, but actually that's not necessarily true when you're employing this kind of strategy.
Yeah, it's I always find it interesting what people consider a quality stock, and often it's a stock that's gone up a lot recently, and and that's the sort of only that's the only, when it comes down to it, that's the only measure that people actually believe signifies quality. And this sort of strategy recognizes that kind of prices do get out of whack with valuation on the downside, but on the upside as well. But if you can capture some of that sort of upside, you almost get two bites of the apple. What we noted, it's good that some of the team will be able to add a bit more like data structure, a bit more evidence behind this. The feeling we had when I first wrote the Surfing the StockRanks article and did that sort of research was you have to actually sell quite quickly when the momentum rank falls. You kind of think, oh well, it's got a momentum rank of 80. Well, there's still a potentially a super stock I should still be holding. But if it's rapidly come down from momentum rank of kind of 95, that drop to 80 might actually be a sign that you should be selling. And like all these things, you can always come up with counter examples. It's on average over all stocks. It's individual decisions can be different, but on average it seems that you want to be fairly quick. And I think that's to do with how the momentum rank uses 1 year and some 6-month price action, is that once that rank starts falling, that means that probably the share price is actually starting to form a downtrend. And the experience is, if there's very little we'll see a kind of price fundamental support, if that value rank is now very low and the price starts falling, it can that kind of people exiting the stock can take the price quite far down before you start to see the likes of myself buying again because it's looking cheap.
And I think that role of momentum is very interesting. So, and I think that's the final sort of value strategy that we're going to just touch on is this sort of the turnaround strategy. And I think the role that momentum plays in a turnaround stock is something that I hadn't really paid much attention to before I joined Stockopedia. But a turnaround strategy sort of tries to look at companies that are already on the rise. So rather than a situation like with the Contrarian approach, where the share price might still be falling, where there might still be more and more value to be found, a turnaround is already benefiting from momentum. So it's already on that upward trend. And interestingly, so value and momentum, both very, very powerful factors, but combined, they are even more powerful. So this was a study that was done a few years ago, which shows that the two strategies together can outperform massively. And actually, interestingly, value, the turnaround strategy, so the VM StockRanks within Stockopedia, are far and away our highest performing combination ranks. So this was some back testing that we did. We actually did this today. We just sort of looked at the average performance of a strategy that buys VM shares ranked over 90 and sells them again once the momentum starts to fall. And from the median return was about 40% over a 10-year period. So not magnificent, but the best of our combo ranks. So Mark, turnaround as a strategy, so sort of following the momentum, buying a stock that's already on the rise. How do you feel about that?
Yeah, it's probably the best way to go. I sort of struggle it a bit with myself because again, I price anchor on that I could have bought it cheaper 6 months ago, but the reality is that it's probably particularly for more cautious investors, it's probably a much better strategy. What I prefer to do is I prefer to buy slowly on the way down. So I accept that I almost never bottom tick the stock on the first purchase, but I never go in with a very large position at the start when something is kind of does have that downtrend, and I quite willing to kind of average down. But I also get that that's quite that's not a strategy that everybody feels comfortable with. So if you're getting a sharp intake of breath of just me describing that, then I think this kind of turnaround high VM strategy is probably a good one for you.
And if you are getting sharp intake of breath, I do recommend watching our other webinar from a couple of weeks ago with Ed, because he is a firm believer of the VM strategy. He does not like to average down, so he'll soothe any anxiety that you might have had from what Mark just said. So we this is just another quick screen. I have noticed, by the way, a comment about whether these screens will be available. Yes, I can share the links. I can add them to the webinar page at the end of the session, so you don't have to recreate them yourselves. But this is just a quick turnaround screen that I set up. Again, I did do this before the market movement today. I was kind of interested to see how many of these sort of turnaround companies were existed on AIM. There were only 5 as of yesterday, but probably a few more as of today. So a few more where the relative strength of the company had started to pick up. So I think we are on the hour now, but Mark, I know you've got a couple of screens that you are interested in at the moment, and I think sorry we've gone on, but hopefully everyone's found it interesting. So Mark, do you want to just touch on some of the ideas that you're seeing from those screens just to close off for the last 10 minutes?
Yeah, that sounds good. Just let me hopefully share screen and bring them up. So we touched a bit about the on the kind of quality side, and here is it rather than going for that kind of turnaround, I'm specifically looking here for the shares that have been sold off potentially unduly in this current market environment. So stocks where people have sold for capital gains tax reasons, sold because they wanted to take the 25% lump free sum out of their SIP, maybe sold because they feared what might happen to AIM stocks in the upcoming budget, and therefore have been kind of big fallers, but have actually been stocks that have generated pretty good return on capital over the last sort of 5 years. So this is what in Stockopedia screening here, you get to choose your return on capital employed as the metric, but there's quite a few options here. So if you're looking more sort of short term, you can use the 12-month trailing, but I prefer this kind of 5-year average because it often looks through the cycle. And again, I'm looking for stocks that might turn around, might be unduly sort of battered down in the current market conditions, but have had kind of relatively good performance in the past. And here's the kind of top list of fallers. So I think a lot of people know kind of focus right here. And again, this had a bit of a gain today. And I'm not sure it's the cheapest stock. I think there's a risk that some of its performance was due to sorry, I need to save my screen first. There's a risk that with something like this, that the really good years were unnecessarily good due to COVID. You see, it's been one of these that kind of went up and was as a COVID winner when everybody was wanting podcasting hardware, and has now sort of come back down. But I think it's still a pretty good business, and if you're willing to take the very long term on that, you could do well. The other ones that kind of stand out, Supreme. So I think one of this was a gainer today, but I think if my memory serves me back, that the government introduced a tax on vaping fluids with this budget. And now I don't know whether that was trialed I think they've always announced a ban on the disposable vapes, and Supreme have made kind of efforts to move out of that sort of product, but they so I think again this is a weird one where the stock is up, but potentially not because of the relief of the AIM part of the budget rather than the underlying impact. So I mean, and I'm not sure I can get comfortable with the vaping side of it, so it's probably not for me. But for those who are, it's got a pretty cheap. It's looking pretty cheap. It's got some momentum behind it still, and looks like it could recover and still do well. One
that leaps out for me. Sorry, Mark. One that
sorry, Carol.
Is Bioventix. I think it probably shows a slight anchoring bias. I've liked Bioventix for a long time, but it's never ever cheap enough. It had a big sell-off earlier in the week, obviously not today. Such a high quality company, really interesting space. But a value rank of is that 25. I mean, obviously still not great value. But compared to its history and with the kind of returns, that return on capital employed figure, I mean, it's just phenomenal, the kind of returns that this company is generating from its revenue. Margins unbelievably high, massive barriers to entry. It manufactures cheap antibodies for use in diagnostics machines. So not the easiest business to replicate. I don't know whether it still operates out of the same little factory, but I went to visit it about 6 or 7 years ago, and it's a tiny little factory in Surrey. It's like a shed, but it's just got the most amazing science going on in there. It's a really, really interesting, nice business. So interesting that it's showing up in a screen like this, where a potential sell-off screen.
Yeah, the risk on this, I think, is you look at that that revenue figure here, and it's only done about 8% CAGR revenue, and then you look at the EPS, and it's actually only done 8% CAGR EPS. Now, so normally when something has a huge operating margin, you expect quite a lot of operational gearing. You know, so if the revenue rises, the EPS rises much quicker, which suggests to me there's some kind of costs. Yeah, the costs are growing as well, so it sort of gives me pause for it. Yeah, like pause. Yeah, and I agree. It's a very high quality business, but I think you have to really know this sort of business, because there's a couple of potential new product lines that come in that could make this, you know, suddenly make these broker forecasts look very pedestrian. But also they're not without risk. So some of them are to do with Alzheimer's, and there's been kind of some accusations of scientific fraud in the Alzheimer's, not with Bioventic specifically, but just in general. So I think it's one that's quite hard to value, because so much of it is in the future, and it's sort of putting faith in that management to find the new products and to be able to sell them. And I think this gives an interesting interesting way we can edit this screen, which is if I add a rule in here, which is the PEG ratio. So for those who sort of and not aware, it takes the price earnings ratio and divides by the growth ratio. So typically a number less than 1 is good, because it means that the growth is much faster than the PE. And it's a bit of a rough estimate, but there's actually some like complex maths behind it that mean that if you can find something that's consistently or as a PE lower than its consistent sort of growth rate, you'll actually do quite well. So here I'm going to go for the 5-year growth, because this is a sort of long-term stock, and I'm going to say, well, if we want a PEG less than 1, suddenly you don't get many hits. So it's interesting that yeah, sort of adding something like that, you know, we can maybe, often it's good to put a bit of you know, you can put in here a little bit of wiggle room, but still you're not seeing a lot of hits here.
Interesting Focusrite still appearing though.
Yeah, Focusrite, Supreme are still in there. It maybe raises that this idea that Dr. Martens might be cheap. I know it's kind of so I'm going to stay, save, and then
less high quality at Dr. Martens than at Bioventic, so I would argue.
Yes, but also if it in some ways the what matters with the quality is not like that really high return on capital, but the ability to redeploy capital at those rates. And I think that's what's certainly at the moment is the risk with Bioventics, is it's got this amazing niche, but it can't grow. Whereas at least Dr. Martens has shown some growth. Now the future isn't looking as bright for Dr. Martens, so it's a sort of different risk with that. But you know, that return on capital has been pretty good. It's had a reasonable brand that has given it some decent figures. So I mean, yeah, again, one to add to the watch list, rather than it doesn't immediately scream value, and particularly with this low momentum figure, but it might be one that's unduly sold off. The classic example, and everybody knows this stock on Stockopedia, because it is a great high quality stock, and that's Somero. And that suffers from exactly the same problem of, it's got this amazing return on capital, return on equity. You know, it's like you would take that that sort of return on capital in a stock any day, but it just can't grow. It just, it's sort of saturated its market for its core products, and so far the new products it's developed, it hasn't been able to it hasn't been able to kind of grow or roll out at anywhere near the same success. So it's a really high quality company, but unless it can find a way of deploying that capital, then potentially it's going to be a bit pedestrian. So a risk you take with this with this sort of this company, I think.
Yeah.
And why you've got to do yes, you start with your quality rank and your value rank, but you sort of need that momentum rank a bit as well for things like this.
Yeah, which is really interesting. And Roland actually wrote an article a couple of weeks ago about the role that momentum has played in his portfolio. So he runs a stock in focus portfolio for Stockopedia, and one of our subscribers asked him which of the rules he puts in for his screening for building that portfolio has had the most impact. And he said he's not sure what had the most impact, but he's been surprised at the role that momentum has played in driving the performance of that portfolio. He was actually showing that of the closed positions in that portfolio, they have just done unbelievably badly. So selling at the right time often because the momentum starts to turn. So yeah, it's an interesting role that momentum can play in portfolio construction. Just quickly, because we're on 12 minutes past 6. You've got a second screen. What are the highlights from that?
Yeah, so this is a classic one where I've just literally looked at stuff with a value rank greater than 60, where it hasn't warned. I mean, some of these like Card Factory I mentioned before, it hasn't warned.
Mark, your screen isn't. You're still showing.
Sorry, I need to share this tab instead. My apologies. There we go. So it's very simple. Well, looking at what's the biggest fallers over the last 3 months, so those likely to be sold off for tax reasons. But I wanted to exclude the likes of, I think people have looked at things like hunting, and hunting potentially looks good value, but it's had a profit warning. The same with quite a few other the biggest fallers. So I specifically looking for companies that haven't had big warnings. I've allowed a small little downgrade, and that can be sometimes you get a broker added, broker does a minor tweak and you get a small fall. But I don't want those, the stocks where the Oxford metrics, that's the broker's forecasts have been cut by 50% or more. I just want the ones where at least on the surface it looks like they haven't warned. And again, you'll notice things like Supreme is coming up. This Kooth is a very interesting stock. So it's a bit of a high flyer. Its value has not been particularly high, but it's a pretty fast grower. What it provides is sort of counselling and psychotherapy services to teens via a curated platform, and it does it with kind of, I guess, a background of people can have one-to-one counselling, but the idea is this is rolled out to all teenagers within a particular school district, and they have a sort of safe space to raise their concerns. And it's grown very rapidly. See here, this is a 40% sort of CAGR revenue stock. It's been loss-making until recently. I think these numbers here out by a decimal point. I think this is going to be I think that's meant to be a 12.5p and a 11.4p. So I think these PE ratios are a little bit out on here. But we
will look into that.
Yes, it's you kind of find these things and it's like, oh yeah, it takes a bit of time to work out what's going wrong, and the data provider has typed missed a decimal point or something like that. But yeah, it's like an interesting stock because it's had this such a big fall, and it's up a bit again today. One of the risks though is that it lost a recent contract. So when I go down here, it had a Pennsylvania terminates its pilot with only 30 days notice. And from what I can tell, there's a bit of a political hoo-ha. It sells quite a lot into the US, and certain sectors of kind of the US politics don't like how this company is operating. They think it adds kind of risks to, or has risks involved with what it does, and are waging quite a campaign against it. So you can see why the stock has fallen off, but equally, if that's true, a P of 12 for a company that's been shown 40% revenue CAGR, is potentially a very cheap stock, even though the value rank, none of the ranks scream great value here, but it's hard to ignore something that's had such a sell-off with no fundamental change in broker forecasts, and they actually confirmed that this hasn't changed their trading performance. So I think that's
interesting with that one. We did some research. Keelan, my colleague, did some research a few years ago on what to do after a profit warning, and I think it's quite clear with a case like that, this isn't a profit warning. This isn't something. It was a one-off contract loss, and obviously that's not a positive thing. It's definitely certainly negative. But the fact that it isn't, they're not warning on profits, so brokers aren't downgrading. It's a different kind of issue to if a company, if something fundamentally has gone wrong, and a broker keeps downgrading, because the conclusion of the profit warning research is generally profit warnings are not an opportunity to buy. Something has gone wrong, and profit warnings follow profit warnings as well. But this is a slightly different case.
Another one that stands out to me is Future. So this is the magazine publisher, although I think a lot of its revenue and profit comes from actually being more like an affiliate marketer. So when you click through from mountain biking world to buy the latest mountain bike, it makes its money on the commission from that, rather than selling you the mountain biking magazine. But still a pretty decent quality business here. And this big drop here is because the CEO left, so it dropped about 20% down here, and was recovered slightly because the CEO handed his notice in. And I mean, he probably was quite highly rated, but I'm not sure that, not sure he was worth the £200 million or whatever was taken off the market cap. So
that's quite a confidence boost, isn't it?
Yeah. Can put that at the top of your CV. And my last company, when I left, the market cap went down by £200 million.
That's how valuable I am.
Yeah. Does anything stand out to you on this list? Is there anything that's on your watch list?
So to be honest, this is these kind of companies are less. They ring fewer bells for me, because they don't include the quality aspect of it, and I always tend to be drawn to the quality aspect. Future is, though, the one that did jump out to me as well. I was very aware of Future when I worked at the Investors Chronicle. Obviously, working in the publishing sector gives you heightened awareness of other companies in the publishing sector, and this was the most notable listed one. It actually now does own Money Week. But when I was at the Investors Chronicle, and when Future was sort of going through a massive acquisition spree, it was cutting a lot of journalists. So it uses a lot of freelancers now for most of its publications. So it went through a big sort of strategic overhaul under its previous chief executive, where they just took out loads and loads of costs, and it really changed the model of what the business was. And that, I think, it was where it went from being a more subscription business to that sort of affiliate marketing business, which does come with higher margins and actually more reliable, stickier customers generally as well. So I think I think it's interesting. I think not ticking the quality ratios that I like to see in a company, But
yes, it's also got a decent operating margin, but when you
yeah,
look down to this return on capital, you could say that's less than its cost of capital even. So yeah, it's and it's probably those it's probably the intangible assets it's got on its balance sheet that's and because it acquired so many intangible assets, that's probably the reason why it's so low. So you sort of have to, you have to do a bit more research and look through that to work out where the real position is, which can be quite tricky. I think it's a bit of a black box from that point of view.
Yeah. Okay, well we're on 1 hour and 20, so we've gone over our optimum webinar time. But hopefully everyone who's stayed the course has really enjoyed the conversation. I've certainly really enjoyed talking about these stocks with you, Mark, and and hearing about what you're interested in, and also your approach to investing, and hopefully that's given everyone who's attended some ideas about how to invest in the current market conditions. Obviously, we've had a good day today as investors, but maybe that won't continue quite the same pace. But hopefully, some of the ideas that we've talked about give you some ideas on how to move forward. So
yeah, best of luck with your finding those bargains in the current markets. I think they're still there. So use the Stockopedia tools, and I'm sure you'll find some successful investments.
Great. Thanks, Mark, and thank you everyone for joining. Bye.